Hey everybody, just a morning update here. So it's Hans Albrecht, 15-year pro market maker, 10 years running a bunch of income funds. Everything here today is for educational and informational purposes only. If you're okay with that, let's keep going. If not, we'll see you next time. This week is a bit sneaky important on the data side, right? We don't have any massive things like CPI or anything, but we do have those sort of medium tier reports, which are kind of important. We talk a little bit about employment. Do we want to get a sign that maybe there's some cracks continuing to widen under the surface of the market? We know that everything's been really driven by AI, and the hope is that everything kind of spreads into the broader economy in terms of profit margins and benefits of AI, productivity, efficiencies, et cetera. Not great for employment overall until we start to see a sort of pivot into what companies see as more of a collaborative sort of aspect to AI, which we're seeing some cases of. So I don't think it's all dire news. I think there's going to be the ability for employment to kind of pivot a little bit. But I've been saying for the past month that we're really shifting away from the builders of AI towards those users of AI, right? So this data is going to sort of help to figure out if that rotation perhaps is going to stop or kind of continue, because it does need a little bit of help from rates, yields, but it doesn't entirely need that, right? So the spread, the benefits are going to spread no matter what. A rate cut is something that the market kind of wants, and we're sort of 50-50 at this point for December, and the market doesn't like that, right? That's 50-50. Think about it. That's just total uncertainty. We don't know what we're going to get. You'd almost rather know that you're not getting it or know that there's an extremely good chance you're going to get it. Markets don't like uncertainty. It's just one of those things, and that's going to keep the sort of volatility genie out of the bottle a little bit, along with that negative gamma that we're seeing out there. So we've got Thursday jobless claims, existing home sales, pretty good for seeing if the labor market is really cooling. Strong claims, solid housing, that could mean a bit more of a soft landing. Weak numbers, we're going to see recession drumbeat kind of come back a little bit, but we're going to get our rate cuts. So we don't mind rate cuts if inflation is in check. And labor is softening. We don't want rate cuts for a severely cracking economy, right? Which I don't think is happening, right? I don't think that's happening. But at the moment, the market is trying to figure out what's going on. So the game plan for me this week is really trying to figure out a little bit more of what are people doing from the standpoint of tech versus broader economy. So we can see here the SPY down a little bit this morning. TLT not really doing much. That's the longer term bonds. Apple down a little bit. It's had an incredible run near all-time highs. Microsoft just sort of meandering. Meta has been a bit of a disaster. Google popping $10 on a whole bunch of people. Berkshire buying some Google for the first time. Now they did buy around 243, so they got in almost $45 lower. So that's a good price on them. Amazon has filled that gap, so I think that's actually an interesting place for me to potentially create some sort of upside structure here, because we filled the gap and the numbers were really fantastic, and the AI run is going to continue for stocks like that. NVIDIA down a little bit this morning. That's one I'm not really big on. I see Peter Thiel sold his whole position. So again, getting out of the builders and a little bit more into some of the other ones. So what is Snow, for example, which is down this morning, but we can see that it's been a relatively good performer. This is kind of an intermediary for that end user that wants to use AI. They tell people, well, what can you do with AI? So that's a positive. Palantir as well. Life-changing kind of software for companies, but it's extremely, extremely expensive. So it's weighed down a little bit by that. Datadog, you can see the results that you can get in these data names. Fantastic, up to 200, pulling back to 180 here. And then there's the names like, any of the crypto names, Circle, which has just gone straight down. I picked up a little bit more the other day at 86. You've got some of the rate plays, kind of like the Rockets and the Zillows, kind of a little bit neither here nor there, because they really do want that mortgage rate to come down. I think they'll do well anyway, because I think housing is actually unfreezing a little bit. And you've got one of the big beneficiaries of AI and what's happening out there, which is the Goldman Sachses, the JPMs. I've been focused more on the Goldman because I want to stay away from banks that have a little bit more of that exposure to loans and things like that, because I do think there's some suffering out there, and it's going to eventually manifest itself in some poor metrics on the bank side. Nebius, still one of my favorite names here, versus a CoreWeave, right? So when I recommended Nebius months ago in my video that was on YouTube, it was about 40 bucks, 45 bucks, something like that. So even after this pullback, it is still just about a double. And I said it's a better choice over CoreWeave, and CoreWeave was maybe around 113. So it's lost about 40 bucks, and Nebius is a double. So I still like it. I think the gap between the two, of course, has narrowed, but I see these great deals. They did a deal with Meta. They did a deal with a massive deal with Microsoft not that long ago, and that was part of how it performed a little better to the upside, gave it a little more punch to the upside. Now the sector, they're off this stuff right now, right? They don't like data center. They don't like power plays. Look at Iron has really come back. I mean, these guys are going to be powering what's going on out there. Some of it might be that there's some talk of these chips that are much more efficient, which I warned a few months ago. I said that's always going to be kind of the sort of issue, throwing a wrench in the sort of builder's basket is going to be, well, what if we always come up with efficiencies, right? So when there's a problem, when we're using too much power, well, you can bet people are working on how to figure that out. So the chips are going to potentially become more efficient. Now, is it an exaggeration to say that that solves the problem? Probably. These companies are all out of capacity, right? There's so much demand from AI inference that it doesn't matter. And so it's quite possible that you're going to just create more demand as prices come down, as efficiencies happen. And that's kind of Jevons paradox a little bit playing out there, because the demand is so absolutely massive. But in the meantime, narrative is everything, right? So they're not interested in the big kind of names that have been, no valuation is too high kind of names, right? They don't want to be in the Oclos. They don't want to be in the SMRs, which I have a small position on, but I'm definitely taking a good look at it. So in the high beta area, there are a few names that I really, really like and that we're talking about in Leaps Trader. But overall, I'm going to keep it to the big ones. I've been saying all along, you can hide in MAG, but specifically Apple and Google, which are basically near all-time highs. So that was a good call there. I also liked Amazon. I was a little nervous before the earnings, but I think things are back on board there. Meta, I have not been pushing very much at all. Have very small position in that, and that is going the wrong way. I just don't see them. If you think of Meta, they're 90% revenue, 90% plus revenue. Yes, they have 3 billion eyeballs, and they're going to sort this out at some point. But think of a Meta versus a Google. Google is everywhere. Everywhere you look, Google has opportunity, whereas Meta is a little bit more advertising. And yes, they have incredible heft in terms of user base, and they can perhaps do a little bit better with some of the assets that they have, and they're not going anywhere. But in this market, it has become show me now rather than show me later, right? And so right now, Zuckerberg wants to spend. He said, I don't care how much I spend, kind of, in a way. He's almost doing a little bit of an Altman. People don't like that, right? He said that years ago with his metaverse. They did not like that. And then the year of efficiency came in, and they started to love it again. But he's very competitive. He's going to go for it. He's trying. He's maybe not sending the right message, but he is spending, and they're worried that he's not going to exactly give the investors what they want, at least in the near term, right? So remember, the market is not always about good story, bad story. It's also about good story, but maybe dead money for a while, right? So you have to remember that doesn't mean they're just completely soured on Meta. It means there could be better opportunities right now. My one worry is that that mentality seems to be pushing into fewer and fewer stocks, right? I mean, how much longer can Google and Apple be kind of sort of lifting everybody? Microsoft hasn't really gone anywhere, which I think is a good potential position there. And then I'm going to continue positioning in some of the financials, and then really in healthcare and biotech. So you should think of biotech as kind of maybe the new sort of high beta tech, right? So that the high beta names that really caught hold. Imagine that this narrative starts to spread. I did talk about this months ago. Like, how does this not help healthcare? It's going to be absolutely massive for compressing the time to discover things, for all the processes that they have. I mean, this is going to be industry changing, right? It's going to be absolutely industry changing. So probably make it a little bit more competitive, but it's going to be industry changing. So I kind of like picking away at this. One of my lottery ticket ones is RKG, which is AI super high octane with biotech. So that's going to come with more volatility. But if we look at XBI, which is the biotech ETF, look, it's just had a wonderful run, and it's probably maybe going to consolidate a little bit here, but that's a little bit more of a safer play, in my opinion. So I think we're going to wait for the data this week, and I'm a little bit worried that what we're going to get is maybe a lid on high beta. Like, I even think Google's probably a sort of for me, I'm going to do a little bit of lightning there, I think, on the open, because I think generally there's just sort of a big weight on that whole tech sector, and MAG has had a good run overall, right? If we look at the MAGs sector here, the MAGs ETF, look, it's pushed back. It came back towards this. We need to really regain this trend line as well as this 9-day EMA, and then that could give us that run into the end of the year. But for now, it's not in a good place. So I think you just have to recognize that there's a little bit of a shift and pivot going on. Is AI done? No, it's still relatively early innings as we look to the next 5-10 years. But this is how things work in the market. There's money flows like water, and it's gonna eventually. Sometimes there's a narrative change and just a bit of a subtle pivot. And you have to recognize that if you keep sort of pushing into the things that worked for a long time and they're not working now, then that's a signal that you kind of want to, maybe broaden your horizons a little bit, because there's a big market out there where they're starting to look at things that trade at reasonable PEs, right? Not just the S&P top 10, but the S&P 490, which you can find some real gems in there with opportunity. We're not seeing the broadening playing out in the IWM. I want to see that to further strengthen that broadening idea. We're not exactly seeing that. But having said that, if you're positioning in names that have reasonable valuations, that have a good outlook over the next couple of years, that's going to be a little safer than 400 times earnings kind of stock where competition is rising in chips, et cetera, et cetera. So there are my favorite names in there. I love my certain data plays. And I love Google, Apple, Amazon. There's certain plays in there that I think still maintain. Like, if you think of Google, it just has its fingers in everything, right? So it's got chips, it's got AI to the brim, it's got data that OpenAI just can't compete with. It just has so many things, that ecosystem of productivity, this productivity suite. So you really want to, and then other things like Apple, AI plus physical, right? So I like AI plus physical. I think Tesla's that as well, but lately it has suffered from the high valuation, right? So they want to see some of this. They want to see that robotics are certain to help. And the power element to Tesla that I mentioned in a couple of videos, that power element is under threat right now. If you look at, CCJ, something like that, they're off this power thing. Now, have they hammered them too much? Well, quite possibly. So I'm definitely looking at a few high beta names like an IREN, like a Cipher. A couple of these guys have, basically pipelines right into nuclear. They're ready to provide power. This isn't changing, right? I'm not looking at these pullbacks and saying, well, the story is completely changed. We're not going to need as much power. We're not going to need as much compute. We're not going to continually need to build data centers, especially abroad, like in Europe and places like that, where Nebius is going to maybe have a little bit of a leg up. That's not changing, but money flows, and right now it's out. But I think I'm going to be looking at the very, very, very best stories and names for me, where I want to stick my neck out a little bit. Where I don't want to stick my neck out, I'm going to put some money into things that make a little bit more sense, or a little bit more broadening, almost value-based. But at least the way I see it is, you want either an extremely strong story that might have a high valuation. Maybe you could put Palantir into that category. but extremely strong story, but high valuation. So that could be okay on a pullback, or you want reasonable valuation with a really good story. So you want to kind of think of things in those terms. So like an MU, for example, still relatively reasonable valuation in a story where they're raising prices left, right, and center. Look at the SanDisks, look at all these memory exposure type names. There's a lot of power in there. But if the data center, canary in the coal mine is sort of, we can't sell any more capacity. Well, that matters, right? The stock market isn't just about stories. It's also about, well, it's sales, it's revenue. It's if they can't make more revenue because there's a supply chain blockage somewhere, then that's an issue for these companies, right? It's a good issue. There's tons of demand. It's like walking into a McDonald's and saying, I need 4,000 burgers. They can't make them for you right away. It's a nice problem to have. Everybody wants your burgers. Which certainly isn't happening in Chipotle right now for burritos and all that. But as an aside, but if the demand is there, that's a wonderful thing. But if you can't satisfy it, and if we've got a shortage of elements in the world because of this big build out, then that's a little bit of an issue as well. So that we have to recognize. So again, that's another thing that speaks to my just being a little bit cautious on the physical build out right now, unless it's combined with some other really, really great things. So hopefully that covers things, and we will see you a little later. Again, don't forget, big launch this week for my Turbo Trader Pro income scanner. It's going to be unbelievable. There is nothing like this on earth. 30 years, decades of what's in my brain, how I find these opportunities. It isn't as simple as selling a put on a pullback on a red day. It is not as simple as that if you want to make money. You'll notice one thing about income trading is everyone can do it very well for some time, and then they give it all back or they give more back. You need the right approach, because the best defense is incorporating defense into your offense. What does that mean? That means making better decisions. It means setting yourself up better. It means avoiding stepping in those piles of you-know-what as much as possible. Those are the problems. Stepping in the piles of you-know-what are the big problems. I've got my exit strategy that you're going to get. It's just an absolutely all-encompassing income plus turboing the upside when it makes sense, because everyone knows I hate upside. What has happened lately? A whole bunch of people have said, wow, this has been a great run in the market. I've done okay on my income, but I missed out on gigantic amounts of upside. I've had people reach out to me and I say, listen, you need to have a more holistic view of things, because if you're getting rid of, if you're not capturing that upside, then you're not taking full advantage of what's out there, right? So it's really an approach that comes with all those different guardrails, and I'm really, really excited about it. We're going to have a nice Black Friday entry, but it's going to be limited, right? So I can't have too many people. We'll probably limit it to about 50 people to start, just to kind of get things going. There are live classes every week. There's a ton of value. There's learning, there's courses. There's just a massive amount of value, and I can't have 300 people, reaching out to me, asking questions, inundating us. So we need to kind of tiptoe into this, but you want to get on that wait list. So look down below, get on the wait list, and we'll see you guys soon.